to dig in for everything. Also, we've got to adjust that for the amount that is going to be set up, just like we would set up our salary expense, we would set up our payroll tax expense.
Now, this is before and this is just a balance the year you look.
Yes.
This is just so we can show these expenses on this year. Doesn't have anything to do with setting up the payroll or anything. Just that we've got to find everything that happened in that year that was an expense.
Okay. So there's our salaries expense, salaries payable. That's how we would set it up to show that
And there's
amount of
no
expense.
asset account for this part.
What would be the asset account for setting up your salaries expense?
Salaries.
Salaries is not an asset. What is it? It's not a liability either. What is it?
Oh, there's equity.
No, it's not equity. What is salaries? What does it say?
Expense.
It's an expense of your company when you pay salaries out to your people, right? It's an expense. Okay. Right? When you set up your payroll, how do you set it up? You set it up as expense, right? You set up your salaries expense first. Then you set up your amount you withheld as all the payables, right? And then the last payable, when you set up your thing, is the part you're going to pay the people, right? But in this case, we're just wanting to get that expense on our books, so we go ahead and set up the expense part so we can count it, and then we set up our payable. That's the credit part of it. Okay? All right. So we're digging for more expenses, right? We're just getting down there to see if we can find every expense. So, and to answer your question, Jimmy, when you pay the payroll, right? It's time to pay. It's payday. That's when. See, we're not paying them yet, right? That's when you would debit the payables account, right? To pay them and credit your cash, and that's where your cash is going out. And that's what you're looking at. Okay? But I wanted it to be clear that at this point we're not paying them yet. We're just setting up that expense, like when you set your payroll up to begin with before you pay them. Okay? Because we're not paying them. So, okay, good. Good thinking. Good thinking, everybody. Okay. So, there we are, and we go ahead and try to figure out the amount of our, we're going to have to match on that, right, to show it as our employer's part of his expense, payroll tax expense, plus the part that he has to pay on that, plus FUTA and SUTA, which we're going to show in a minute. So we set up for his part of the expenses on that part, payroll, and also FUTA for the unemployment insurance and SUTA part. So we have to go in and figure that. Okay. So any part of your employer's expenses on payroll, which we looked at in chapters 10, part of it, and then in chapter 11, the rest of it, those employer part, we would go ahead and figure. So we could take that part on that little measly $1,200, right? Okay. But it still has to be put on. It might be $12 million in some companies. So let's not make light of it. Our numbers are small here. You might think, well, why do that? But they may be big for some companies, okay? Everybody kind of got the... Yeah, right. That aren't playing right now, right? I hope they're not drawing their salaries, but I'll bet you they are. Yes.
And then they send it, and it's automatically entered into one big thing, or is there a bunch of people
that's your,
minute.
your degree with your accounting. Yeah. You can start in as a bookkeeper at that level, and that would be probably the way they start you at the local level. And to go back to the hometown boy story from Calico Rock that became the CFO of Entergy and retired from them and now works for an oil company in Dallas. His bonus alone this year as their accountant was $1 million. Not his salary, that's only his bonus. So there's, just to let you know, it can happen. Don't ever think just because you're from here or there or whatever, you got the, you go for it and you've got the time. There's no limit. Okay. So, there's our, so we're estimating all of the ways that we could count those expenses right toward the end. Now, there's our adjustments for all of it. We're putting it all in there as expense, and then we're showing it, we'll go ahead and put it in our payable accounts. Because next year when we do pay it, we got to pay those, right? So it's already in there for that amount. Now, here's the little, well, let's go ahead. And interest on notes payable, we talked about it. You took out the note on 2 months on December 1. So for the month of December, you owe them the interest on having their money for that month. Right? If they were making you pay your interest by the month, you'd be paying the interest accrued each month. Like, okay? So the government took $350,000 on it. The government took $350,000 on it. Interesting, isn't it? See, you just don't ever think you're limited. And he was just that's what they took for taxes out of that million. I know. Well, it's 35%, which is actually lower than it used to be 50%. 40 to 50, or 42, something.
Bonuses?
Yeah.
Is that for bonuses?
Well, it's for corporate. In this case, it may be set up for bonuses of officers of large companies. Because the tax rate on businesses has changed too since Bush, because of President Bush, it got low. Now it's probably going to get set back up, just like Obama's trying to increase the inheritance tax to unreasonable amounts. Everybody go vote. So anyway, yeah, it's amazing. But things like that, and then there have been some good things done for the lower level income groups. I have to say that. Okay. So we issued this note. So we're having to pay. We owe them the interest, because if we went at the end of December and paid it, we'd only have to pay interest for that month on the total, right? Because we'd have paid it off, and we wouldn't have to pay the interest for January. Okay, so this is another way. We go in and we figure it. We find out how much the interest would have been using our principal times the rate times the time. Find out for 1 month. So it's $20. That doesn't sound like but what if that note was for $200,000? Okay, see, it's all relevant, but we have to. So we owed them $20, so we're going to show that as interest expense for that month, right? For this accounting period. Okay, all right. Now you're going to put it in your interest expense, interest payable to show it. Okay. Other kind of prepaid expenses, y'all know what this one is, right? We buy the supplies ahead of time, then we go out there and count and show how much we use. That's one of our adjustments we learned. Chapter 5. Insurance, same way, right? We might buy it for the year, but whatever part has lapsed for that period of time, we show that as an expense. And also if you prepaid your interest on notes payable, it would be handled any go ahead and pay the interest ahead of time. And if you did, then it would just reduce the amount that you have on that payable account. Okay. All right. Prepaid rent, it would. If you had prepaid rent. They're just saying, well, they didn't have prepaid rent. Let's add that one. That's a popular one. I want to add it. We did that one. That was the first one we learned, wasn't it?
Well, when I was reading, I was like, well,
Where's the rent?
yeah, I was like, isn't that?
Sure. Sure is. And it's the one we learned first, though. Gosh, I can't type today, y'all. Huh? Interest? No, I wouldn't myself. But you never know if they gave them a little break on it if you went ahead and paid it. You know. See on some of these car deals, y'all see that on the car deals. Sometimes if you do this, and if you don't take the cash back but take a lower interest rate, it's sort of a same kind of thinking. Okay, back to the. Oh no, she caught me. You're so good. She is helping. Then somebody else would write when I got to the next one. They go, that's 3, that's 4. Can y'all think of any others? Well, I tell you what, let's go ahead and put the ones, and then y'all tell me how many. What are the other ones we learned? So I'd like to have them all in here, actually. What about advertising? We learned that one. It's this keyboard, y'all. Okay. I can't get my hands on it right. What was another one? We had insurance. No, we didn't do the phone. You could do insurance. Oh, there was another one. Jimmy, can you think of one?
No, I can't even see what you got up there.
Oh, okay. We're trying to think of other prepaid expenses we did. We did insurance. There was another one.
It listed it in the book.
Yeah, it did. I just wanted to get it on my slide. Okay, so that's 1, 2, 3, 4, 5. Okay. Now, somebody's going to think of another one in a minute, but. Okay. Now it does, right?
Now I can see it.
Actually, we messed up because Whiteside didn't have those. But that's okay. I'm going to leave them on there. Okay, so accrued income. What's accrued income? We've talked about it because we recognize that even though we haven't been paid for it, we've earned it.
Yeah, I thought it was weird that they could find that
After we'd already talked about it. Yeah. It's called accrued, meaning that it's incurred, and accrued means we go ahead and count it. But we already talked about recognizing it, right? Same thing. Okay. So if we accepted notes receivable, interest income is recorded when it is received, which is normally when the note return matures. However, we earn that interest on those notes day by day, so we have the right to. We have to show it as income day by day, right? Or month by month. So actually, if those people have a note out with us, we've earned the income, or interest income on that note if the time has passed. Okay. It goes under unearned income. No, it goes under accrued income. There should be a spot on there somewhere. When we won't actually see it until we go to the next chapter to